we had an bear market in the first half, then a rebound on hopes that the Fed, in particular on hopes that the Fed would become more dovish, they would have a quick pivot. I think you are not going to see that. You see that clearly illustrated from Jackson Hole and from the ECB as well. So we didn't chase that rally. Now we also think actually that on the bottom end, quite a bottom end for the equity market, quite a lot is priced in as well. So that's why we're kind of stuck in this trading range, and markets will have to do what they're particularly bad at, being patient for inflation and for the economic cycle to be further advanced.
For rates to increase effectively by, what would the number be? I mean, 2.25. In 3 meetings, that's absolutely massive. And to get to that, you'd have that massive jolt upwards. If inflation then does begin to come down as they would want it to, of course, they're trying to bring it under control as quickly as possible. And it really does jolt down very quickly. What's the chances you get that effect where you then have to unwind all these hikes that you've done and you need to do that just as quickly?
Yeah, so that's what we disagree with, right? The market is pricing in some interest rate cuts in 2023. It's taken, the inflation, was very low. Then the genie went out of the bottle. Now, if the Fed manages to cap that inflation, they're not going to, cut very quickly. I think central banks in Europe, in the Eurozone and in the UK as well, are going to do what's necessary. But hopefully not too much. And then therefore, if they indeed do the minimum to try to crush that inflation, but to still not, be overly negative for the economic outlook, then they won't have the scope to cut, and they will want to keep that inflation anchored. On the labor market, we're nowhere near, finding that balance, right, on supply and demand.
For how long does this influence growth then? I mean, how long does it impact growth on the negative side?
So, I think we do get to an equilibrium where, inflation comes back to sort of the 3% level, probably not the 2% level in many countries. You may actually undershoot it for a while due to base effects, but, clearly your equilibrium on inflation is going to continue to be a little bit higher than where it was. That's not necessarily a negative. From an economic growth perspective, what we really need is, more investment spending, in structural projects such as the sustainability revolution, obviously still in the digital revolution as well, and then in terms of the energy independence. So I do think that, when you get more, less recessionary fears, once that sort of fear of recession is behind us, that you will actually get from the business side and from the government side quite a decent amount of investment spending, and that then basically supports economic growth from a longer term perspective.